Question 1. An individual living in Maryland purchases a new whole life insurance policy. According to Maryland law, what is the minimum free look period that the insurer must provide for this policy? A. 7 days. B. 10 days. C. 20 days. D. 30 days. Answer: B. 10 days. In Maryland, most new individual life insurance policies, including whole life, must offer a minimum free look period of 10 days. This period allows the policy owner to review the policy after delivery and, if not satisfied, return it for a full refund of all premiums paid. This consumer protection ensures that buyers have time to confirm the policy meets their needs without financial penalty. Always remember this important consumer right, as it gives policyholders an important window to make sure their decision is right for them. Question 2. Under what circumstances can a life insurance policy's incontestability clause in Maryland not prevent an insurer from denying a claim after the 2-year period? A. If the insured committed suicide. B. If the policy was issued based on a fraudulent misstatement of age. C. If there was a material misrepresentation on the application that was discovered after the 2-year period. D. If the applicant obtained the policy by perpetrating a fraud in the inducement. Answer: D. If the applicant obtained the policy by perpetrating a fraud in the inducement. While the incontestability clause generally prevents an insurer from challenging the validity of a policy after 2 years, it does not apply in cases of fraud in the inducement, which means the applicant never had an insurable interest or intentionally committed a gross deception that rendered the policy void from the start. Misstatements of age result in benefit adjustments. Suicide clauses typically apply for 2 years, and mere material misrepresentations are usually covered by the clause after 2 years. This exception protects insurers from outright criminal deception, so it's a critical distinction to remember for exam purposes. Question 3. A Maryland producer receives a signed application and initial premium for a new life insurance policy. The producer does not issue a conditional receipt. If the applicant dies before the policy is issued and delivered, what would likely happen? A. The insurer must pay the death benefit since the premium was collected. B. The insurer would return the premium, and no death benefit would be paid. C. The insurer would conduct an investigation and then decide whether to pay. D. The policy would be considered effective on the date of application. Answer: B. The insurer would return the premium, and no death benefit would be paid. Without a conditional receipt, coverage typically does not begin until the policy is formally issued and delivered to the insured, and the first premium is paid. If the applicant dies before these conditions are met and no conditional receipt was issued, there is no temporary coverage in force. Therefore, the insurer would simply return the collected premium because a contract was not yet formed. Always understand that a conditional receipt is crucial for establishing interim coverage and that its absence generally means no coverage exists until full policy issuance. Question 4. A Maryland resident wants to surrender their permanent life insurance policy for its cash value. Which non-forfeiture option provides the policy owner with a lump sum of money? A. Extended term. B. Reduced paid up. C. Cash surrender value. D. Automatic premium loan. Answer: C. Cash surrender value. The cash surrender value non-forfeiture option allows a policy owner to terminate their permanent life insurance policy and receive the accumulated cash value as a lump sum. This option effectively cancels the policy, ending all coverage. Extended term and reduced paid up are other non-forfeiture options that keep some form of life insurance coverage in force, while the automatic premium loan is a rider to prevent lapse, not a surrender option. Remembering these distinctions is key because each non-forfeiture option has a very different outcome for the policyholder. Question 5. A Maryland producer is meeting with a client who is replacing an existing life insurance policy with a new one. Under Maryland replacement regulations, which of the following is the producer's primary responsibility? A. To ensure the new policy is issued by the same insurer as the existing policy. B. To provide the applicant with a notice regarding replacement and a completed comparison statement. C. To waive the free look period for the new policy. D. To advise the client to keep both policies in force indefinitely. Answer: B. To provide the applicant with a notice regarding replacement and a completed comparison statement. When a life insurance policy is being replaced in Maryland, the replacing producer's primary duty is to ensure the applicant receives a notice regarding replacement and a detailed comparison statement or statement of comparison. These documents inform the applicant about the potential disadvantages of replacement and allow them to make an informed decision. This requirement is a critical consumer protection measure designed to prevent twisting and churning, so understanding these forms is essential for producers. Question 6. All of the following are generally tax-free to the beneficiary in Maryland except A. The death benefit paid from a life insurance policy. B. Dividends from a participating life insurance policy left with the insurer to accumulate interest. C. Viatical settlement proceeds paid to a terminally ill insured. D. Accelerated death benefits paid to a chronically ill insured. Answer: B. Dividends from a participating life insurance policy left with the insurer to accumulate interest. While the death benefit of a life insurance policy is generally received income tax-free by the beneficiary, and viatical or accelerated death benefits are typically tax-free to the insured under specific conditions, dividends themselves are generally considered a return of premium and are not taxable. However, any interest earned on dividends left with the insurer to accumulate is considered taxable income. This distinction between the dividend itself and the interest it earns is a common exam trick, so always focus on the interest aspect when dividends are mentioned. Question 7. A Maryland resident has an adjustable life policy. Which of the following policy components can be changed by the policy owner? A. Only the death benefit. B. Only the premium. C. Both the death benefit and the premium. D. Neither the death benefit nor the premium. Answer: C. Both the death benefit and the premium. An adjustable life policy offers the policy owner significant flexibility, allowing them to increase or decrease both the face amount, death benefit, and the premium payments to suit changing financial needs. This adaptability is a key characteristic that distinguishes it from more rigid whole life policies. Think of it as a policy that can adjust to the insured's life circumstances, which makes understanding its dual flexibility important for exam success. Question 8. In Maryland, an authorized insurer is undergoing an examination by the Commissioner. How often, at minimum, must the Commissioner examine the financial affairs of every insurer authorized to do business in the state? A. At least once every year. B. At least once every 3 years. C. At least once every 5 years. D. At least once every 10 years. Answer: C. At least once every 5 years. The Maryland Insurance Commissioner is mandated to examine the financial affairs and condition of every authorized insurer at least once every 5 years. This regular oversight helps ensure the financial stability and solvency of insurance companies operating within the state, protecting policyholders. Knowing this specific timeframe demonstrates understanding of the regulatory environment and the Commissioner's role in maintaining market integrity. Question 9. What is the primary purpose of the Maryland Life and Health Insurance Guaranty Corporation? A. To regulate premium rates for life and health insurance policies. B. To protect policy owners, insureds, and beneficiaries against an insurer's insolvency. C. To investigate claims of unfair trade practices by insurers. D. To license and regulate insurance producers in Maryland. Answer: B. To protect policy owners, insureds, and beneficiaries against an insurer's insolvency. The Maryland Life and Health Insurance Guaranty Corporation was established to protect policyholders in the event that an authorized life or health insurance company becomes insolvent and cannot meet its obligations. It provides a safety net by covering claims up to certain limits. This organization acts as a form of consumer protection, separate from direct regulation or producer licensing, so remember its role as a safety net for insureds when an insurer fails. Question 10. A Maryland resident owns a life insurance policy and wants to ensure that if she dies, her 3 children receive equal shares of the death benefit, and if one child predeceases her, that child's share passes to their heirs. Which beneficiary designation should she choose? A. Per capita. B. Per stirpes. C. Revocable. D. Contingent. Answer: B. Per stirpes. A per stirpes, meaning, by the roots, beneficiary designation ensures that if a named beneficiary predeceases the insured, that beneficiary's share will pass to their descendants, heirs, rather than being split among the surviving named beneficiaries. In contrast, per capita means, by the head, where surviving beneficiaries share equally, excluding the descendants of any deceased beneficiaries. This distinction is crucial for understanding how death benefits are distributed, so remember, per stirpes is about generational distribution. Question 11. Which of the following statements about industrial life insurance in Maryland is true? A. It requires medical examination for all applicants. B. It has large face amounts, typically over $100,000. C. Premiums are collected weekly or monthly by an agent. D. It is primarily sold to high-income individuals. Answer: C. Premiums are collected weekly or monthly by an agent. Industrial life insurance, as defined in Maryland, is characterized by small face amounts, usually under $10,000, and premiums that are collected frequently, often weekly or monthly, by an agent who visits the policyholder's home or workplace. It is typically marketed to individuals with modest incomes and does not usually require a medical exam. Think of industrial as implying small, frequent transactions, which helps to remember its key characteristics. Question 12. In Maryland, an insurer is required to give notice of an adverse underwriting decision to an applicant within how many days after receipt of the completed application? A. 10 days. B. 21 business days. C. 30 days. D. 45 days. Answer: B. 21 business days. Maryland law requires an insurer to provide notice of an adverse underwriting decision, such as a declination or offer of coverage at a higher premium, to an applicant within 21 business days after receiving a completed application. This timeframe ensures prompt communication with applicants regarding their insurance status. This specific business day requirement is a common detail tested on the exam, so committing it to memory is a good strategy. Question 13. A policy owner in Maryland has a participating whole life insurance policy and opts for the paid-up additions dividend option. What does this option accomplish? A. It converts the policy to a fully paid-up policy. B. It uses the dividends to purchase additional small single premium policies of the same type. C. It reduces the next premium payment due. D. It pays the dividends to the policy owner in cash. Answer: B. It uses the dividends to purchase additional small single premium policies of the same type. The paid-up additions dividend option uses the policy's dividends to purchase small, single premium whole life policies. These additions increase the policy's death benefit and its cash value, effectively accelerating the policy's growth. This option is beneficial for policy owners who want to maximize their policy's value without paying additional out-of-pocket premiums. Remember that additions implies growing the policy, which helps connect it to increasing the death benefit and cash value. Question 14. What is the main difference between a straight life annuity payout option and a life annuity with period certain option? A. A straight life annuity provides a guaranteed income for life, while a period certain guarantees income for a specific number of years, even if the annuitant dies. B. A straight life annuity provides a higher periodic income than a life annuity with period certain for the same initial principal. C. A straight life annuity is only available for variable annuities, while period certain is for fixed annuities. D. A straight life annuity has a beneficiary option, while a period certain does not. Answer: B. A straight life annuity provides a higher periodic income than a life annuity with period certain for the same initial principal. A straight life annuity pays the highest periodic income because it guarantees payments only for the annuitant's lifetime, ceasing upon death with no residual value for beneficiaries. A life annuity with period certain, conversely, guarantees payments for a specified period, example 10 or 20 years, even if the annuitant dies, meaning the payments are lower to account for this added guarantee. The trade-off is higher income for less certainty in a straight life annuity versus lower income for guaranteed payments with period certain. Question 15. A Maryland resident has a waiver of premium rider on their life insurance policy. If the insured becomes totally disabled, what must typically happen for the rider to take effect and premiums to be waived? A. The insured must prove disability for 30 days. B. The insured must be unable to perform their current job. C. The insured must satisfy a waiting period, usually 3 to 6 months. D. The insured must be hospitalized for the duration of the disability. Answer: C. The insured must satisfy a waiting period, usually 3 to 6 months. For a waiver of premium rider to activate, the insured must typically meet the policy's definition of total disability and then satisfy a waiting period, which is commonly 3 to 6 months, 90 to 180 days. Premiums paid during this waiting period are usually refunded once the disability is confirmed and the waiver begins. This waiting period is a common feature of disability-related riders, so remember it as a key condition for activation. Question 16. Which of the following actions constitutes twisting as an unfair trade practice in Maryland? A. Misrepresenting the terms of a policy in order to induce a policy owner to surrender an existing policy and purchase a new one with a different insurer. B. Offering a prospective client a portion of the producer's commission as an inducement to purchase a policy. C. Making a false statement criticizing the financial condition of another insurer. D. Persuading a policy owner to replace a policy within the same company for the sole purpose of generating new commissions. Answer: A. Misrepresenting the terms of a policy in order to induce a policy owner to surrender an existing policy and purchase a new one with a different insurer. Twisting is an illegal unfair trade practice where a producer, through misrepresentation or incomplete comparison, persuades a policy owner to surrender an existing life insurance policy from one insurer to purchase a new policy from a different insurer. This action is designed to unfairly benefit the producer by generating a new commission. Understanding this specific definition, especially the involvement of different insurers, is crucial for distinguishing twisting from other unfair practices like churning. Question 17. In Maryland, what is the standard grace period for an individual life insurance policy? A. 10 days. B. 20 days. C. 31 days. D. 60 days. Answer: C. 31 days. Maryland law, like many other states, mandates a grace period of 31 days for individual life insurance policies. This period allows the policy owner additional time to pay an overdue premium without the policy lapsing. If the insured dies during the grace period, the death benefit is typically paid, less any unpaid premium. This grace period is a crucial consumer protection, ensuring policyholders have a brief window to avoid an accidental lapse in coverage. Question 18. A Maryland life insurance applicant is offered a conditional receipt. What does this receipt generally mean regarding the effective date of coverage? A. Coverage is effective immediately, regardless of insurability. B. Coverage is effective on the date of application or completion of medical exams, provided the applicant is found insurable. C. Coverage begins only when the policy is formally delivered. D. Coverage is guaranteed to be issued within a specific time frame. Answer: B. coverage is effective on the date of application or completion of medical exams, provided the applicant is found insurable. A conditional receipt provides interim coverage, meaning that coverage may be effective as of the date of application or the date of the medical exam, whichever is later, provided the applicant is found to be insurable according to the insurer's underwriting standards. If the applicant is later found uninsurable, no coverage was ever in effect, and the premium is refunded. This type of receipt offers peace of mind to applicants while their application is being processed, but it is not a guarantee of policy issuance. Question 19. A Maryland insurer wants to use an HIV test in its underwriting process for a life insurance policy. Which of the following is required by Maryland law? A. The insurer must always decline coverage if the test is positive. B. The insurer must obtain the applicant's written informed consent for the test. C. The insurer must pay for the applicant's treatment if the test is positive. D. The insurer must disclose the test results to the applicant's physician without specific consent. Answer: B. The insurer must obtain the applicant's written informed consent for the test. Before an insurer can require an HIV test for underwriting purposes in Maryland, it must first obtain the applicant's specific written informed consent. This ensures the applicant is fully aware of the test, its purpose, and how the results will be used and kept confidential. This consumer protection measure protects an individual's privacy and autonomy regarding sensitive health information. Always remember that informed consent is paramount for such medical tests in insurance. Question 20. Which life insurance policy would be most suitable for a young couple in Maryland who have limited income but want the maximum death benefit protection for the next 20 years, while being able to convert to permanent coverage later without proving insurability? A. Whole life. B. Universal life. C. 20-year level term. D. Variable life. Answer: C. 20-year level term. For a young couple with limited income seeking maximum death benefit for a specific period, 20 years, and the option to convert to permanent coverage later, a 20-year level term policy is the most suitable. Term insurance provides the largest death benefit for the lowest initial premium compared to permanent options, and the convertibility feature allows them to secure permanent coverage without reproving insurability later when their income might be higher. Whole, universal, and variable life policies are more expensive initially due to their cash value components and lifelong coverage. Question 21. Under a Maryland life insurance policy's misstatement of age clause, if an insured incorrectly states their age on the application and this is discovered after their death, what action will the insurer take? A. The policy will be voided, and all premiums will be returned. B. The death benefit will be adjusted to the amount that the premium would have purchased at the correct age. C. The claim will be denied due to material misrepresentation. D. The insurer will charge the beneficiary the difference in premiums. Answer: B. The death benefit will be adjusted to the amount that the premium would have purchased at the correct age. The misstatement of age clause is a standard policy provision. If the insured's age was incorrectly stated on the application, the insurer will not void the policy or deny the claim. Instead, the death benefit will be adjusted to the amount that the premium paid would have purchased at the insured's correct age. This ensures fairness to both the insurer and the policy owner, maintaining the contractual relationship while rectifying the premium discrepancy. Question 22. Which of the following is a prohibited act in Maryland known as churning? A. Making false statements to induce a policyholder to replace a policy with a new one from a different insurer. B. Offering a client a portion of the producer's commission as an incentive to buy a policy. C. Inducing a policyholder to lapse or surrender an existing policy for a new one with the same insurer for the purpose of earning additional commissions. D. Spreading malicious information about another insurer's financial standing. Answer: C. Inducing a policyholder to lapse or surrender an existing policy for a new one with the same insurer for the purpose of earning additional commissions. Churning is an unethical and illegal practice where a producer encourages a policyholder to replace an existing policy with a new one from the same insurer primarily to generate new commissions, rather than for the policyholder's best interest. The key differentiator from twisting is that churning occurs within the same company. This practice is detrimental to the policyholder as it often involves new surrender charges and commissions, so recognizing this specific definition is vital. Question 23. An applicant for a life insurance policy in Maryland is required to provide a certain level of personal information on the application. According to the Fair Credit Reporting Act, if an insurer obtains an investigative consumer report on the applicant, what must the insurer do? A. Provide the applicant with a copy of the report automatically. B. Inform the applicant that a report may be obtained, and if requested, provide information about the reporting agency. C. Obtain written consent from the applicant to access any medical information. D. Guarantee the applicant will be approved for coverage. Answer: B. Inform the applicant that a report may be obtained, and if requested, provide information about the reporting agency. The Fair Credit Reporting Act, FCRA, regulates how consumer information, including investigative consumer reports, which involve interviews with neighbors, employers, etc., can be used. While insurers do not automatically provide a copy of the report, they must inform the applicant that such a report may be obtained. If the applicant requests, the insurer must disclose that an investigative consumer report was ordered and provide the name and address of the reporting agency so the applicant can obtain a copy if desired. This balance between underwriting needs and consumer privacy is a key aspect of FCRA. Question 24. A Maryland resident owns a variable life insurance policy. Which of the following statements about the cash value of this policy is true? A. It is guaranteed to grow at a fixed interest rate. B. It is invested in the insurer's general account and is guaranteed. C. It fluctuates based on the performance of the separate accounts and is not guaranteed. D. It can only be accessed upon the policy's maturity. Answer: C. It fluctuates based on the performance of the separate accounts and is not guaranteed. Variable life insurance policies allocate their cash value to separate accounts, which are invested in various securities like stocks and bonds. As a result, the cash value of a variable life policy is not guaranteed and can fluctuate up or down based on the investment performance of these underlying separate accounts. This investment risk is borne by the policy owner, making it distinct from fixed value policies like whole life or universal life. Question 25. A Maryland producer intentionally fails to disclose a known material fact during a life insurance application process. This action is considered an example of A. Rebating. B. Concealment. C. Defamation. D. Waiver. Answer: B. Concealment. Concealment occurs when an applicant or producer intentionally withholds or fails to disclose a material fact that is relevant to the insurer's underwriting decision. A material fact is one that, if known, would have influenced the insurer's decision to issue the policy or the terms of coverage. This act violates the principle of utmost good faith in insurance contracts. Remember that concealment is about hiding information that should have been disclosed, whether by omission or deliberate non-disclosure.